Morning, everybody. In today's video, I'm going to be talking about JP Morgan's JEPQ, which is JEPQ on the NASDAQ. But basically what it is, it's a covered call option income equity fund. And basically what that means is it uses covered call options to generate income against underlying stock positions, which generates larger yields for the investors of the ETF. This is something that actually has been a lot more popularized since COVID came around. More people were looking for these kinds of options. So basically how they make money with options is first, I'll talk about the buyer. A call option buyer stands to profit if the underlying asset stock rises above the strike price before expiry. A put option buyer makes a profit if the strike price falls below the strike price before expiration. And the strike price is basically the price at which a stock option or contract can be exercised. The spot price is where the holder of the contract can exercise it. So there's a spot and a strike price, and the difference between where one or the other gets out is where the profit is earned. So the option seller earns premium as income, or if the spot price is below the strike price, the option seller earns against the premium. So if you're not familiar with options at all, this is all pretty confusing. But the more that gets explained, the more that gets talked about, the more you get into. And this isn't that kind of video. I'm just explaining where the profits come from. So they're buying and selling contracts between like spot and strike prices. So that actually has a very strong impact on the price appreciation value of these ETFs. So you would think that JP Morgan's JEPQ ETF would actually rise more in value because they have a handful of maybe like 100 different NASDAQ stocks in their portfolio that they're writing covered call options against. But the reason why these particular ETFs don't rise in value really kind of sort of falls upon the fact that there's a strike price and the stocks get exercised on that strike price, or they get called away, or the fund buys back the call option at a loss. So that has a negative impact on the appreciation value of the ETF. So another way in which JP Morgan kind of sort of mitigates the downside and kind of sort of helps the upside a little bit with this is through a structure called ELNs, or equity linked notes. And that's very important because these are like fixed income assets that are used to mitigate the downside and help recover more quickly. And then they're also technically a pass-through. So dividends or distributions can be turned into dividends through a pass-through. And I'll explain that a little bit later. The idea behind these ETFs is really just to provide additional income. This isn't income that is going to be increased quarter over quarter. This isn't an income that's going to be something that you can just take and rely on forever because inflation is going to eat away at the value. You'll want to put some of that back in so you generate more income from your ETF. And the income from the ETF is variable. You can see that JP Morgan's JEPQ is sometimes in the 9.5% annualized rate, and I've seen it up around 12% annualized rate. So it does have a bit of a fluctuation to it. With that, I'm going to explain ELNs. How ELNs work. In the simplest form, a $1,000 5-year equity-linked note could be structured to use $800 of the fund to buy a 5-year strip bond with a 4.5% yield to maturity, and then invest and reinvest the other $200 in call options for the S&P 500 over the 5-year life of the note. There is a chance the options will expire worthless, in which case the investor gets back $1,000 initially put in. If, however, the options appreciate in value with the S&P 500, those returns are added to the $1,000 that will eventually be returned to the investor. The fund packages its calls into an ELN instead of directly selling the call options. This structure allows the fund to pass through all the premiums it earns for investors as dividends. Instead of using like the distributions and paying it out as a distribution, it's taxed as ordinary income, which is at a higher tax bracket. Instead of as a capital gains tax is what they're doing here, then the dividend is taxed at the much lower capital gains rate. JP Morgan's JEPQ, and if the dividends had been reinvested back into the ETF, they opened up May 4th of 2022 at about $47 a share. They're currently sitting at a price of about $55 a share. But if the dividends were reinvested back into the ETF, then you would have a 13.81% compound rate of return. That's a little bit misleading because this fund opened up in the middle of a recession and the price was kind of suppressed because of that. But otherwise, I'd suspect you'd probably be able to at least get maybe 12% out of it if you reinvested the dividends. But like I say, if you're in this for income, and a lot of people buy these just for the income, then I would say you could probably put maybe 25 to 50% of your income back into JEPQ and then actually increase your payouts over time with JEPQ. It's very solid, very stable. The 15% to 20% in ELNs that this company owns is actually creating a lot of stability in the stock price, mitigates the downside, keeps it positive towards the middle 50s. I don't really see, I really don't see this ETF gaining much more than $50 a share, $55 a share, but it will at least keep that price and will pay consistent, regular distributions as dividends, probably for a very long time. The management was also very adamant in saying that they never intend to actually beat the market, but they do intend to deliver solid yields. And that's exactly what they're doing. I would definitely put this in my portfolio. I would definitely use it for an income to provide for things that I may not otherwise be able to afford or maybe just help with, but it is definitely something to have as a long-term hold in your stock portfolio. That's all I have for on this one. Thanks for watching and stay lazy.